My dad was working two minimum wage jobs when I was young. He worked at a convenience store from 6 a.m. to 6 p.m., came home for dinner, and then from 7 p.m. to 11 p.m., he was a pizza boy. And so growing up, money was a scarce resource. And I remember when I was probably in sixth grade, all of my peers are wearing Nikes and Air Jordans. And, when you're so young, all you want is a pair of branded shoes, right? And I remember asking my parents, and they said, we just can't afford that.
Was there a risk that you ever were worried that somebody would get mad by this and tell the teachers that you were sort of illegally selling Cinnabons at school?
Yeah. I mean, I've been suspended a few times and I got in trouble a few times, and I would always try to finagle my way through it. But yeah, I mean, I was considered a rebellious kid because I'm doing something I'm not allowed to do. But when should you hire in-house versus maintain kind of an external partner? This can also bleed into what's the level of advancement, or what's the level of understanding of the functionality of the business as an entrepreneur, and how deep should you go into marketing or finance or ops, etc. I think all founders should have a baseline understanding of their accounting. I think they should have an elementary understanding of their finance in the early stages.
So I'm so excited to welcome Faheem Siddiqi to the podcast today for a ton of different reasons. One, as usual, I find this fascinating to have these conversations because I get to learn from amazingly smart people like Faheem about things that I care about, which I think are things that other entrepreneurs also care about. But then on top of course, Faheem has this amazing background. He is the founder and CEO of Finance Within. He is a board member at UT Austin. He is a board member at Entrepreneurs Organization. He worked at Facebook for a little bit of time. He also writes an impressive blog, which we're going to have to dig into and put him on the spot and ask him how he thinks he did with his 2023 predictions, given we're recording this near the end of 2023, and see, it's always brave to put out predictions for the year and see how it actually turns out. But just generally learn from Faheem especially we're going to focus today on what it means from a financial perspective as a company and founder who helps other startups with their finances. What does that look like? Why is that critical? How should startups really be thinking, and startup founders be thinking about the finance side? Because it tends to be, I believe, this sort of side piece that hey, I just raised a ton of venture capital money and then I'm just going to go back to building products and getting customers, which is a very legitimate area to focus on. But you should also be paying attention to your finances. And that's why having this conversation with Faheem is so exciting for me. So Faheem, thank you so much for joining us today.
Adam, thank you for having me. I'm excited for the conversation.
Good. So I always like to start with just walk me through kind of your background and history a little bit, right? So you not only are a board member of UT Austin right now, but you went to UT, which makes sense. And you live in Austin and work in Austin. So you go to college at UT Austin and then you graduate. What made you take the path that you went on immediately thereafter? And obviously this leading to becoming an entrepreneur, but why did you take the kind of early career paths and career choices that you made?
Yeah. And Adam, if it's helpful, maybe going even further back would kind of help paint a picture of how.
I love that. Yes, please. It wasn't on your profile, so I wasn't totally sure, but yes, let's go further back. I would love it if you told me I was selling lemonade from the biggest lemonade stand in Austin or something. Yes, please tell that story, whatever the story it is.
Happy to. So I mean, I grew up in a very modest and humble sort of family and background. My dad was working two minimum wage jobs when I was young. He worked at a convenience store from 6 a.m. to 6 p.m., came home for dinner, and then from 7 p.m. to 11 p.m., he was a pizza boy. Wow. And so growing up, money was a scarce resource. And I remember when I was probably in sixth grade, all of my peers are wearing Nikes and Air Jordans. And, when you're so young, all you want is a pair of branded shoes, right? And I remember asking my parents, and they said, we just can't afford that, right? So from an early, and rightfully so, from an early age, I felt like I kind of needed to create my own way. And so when I got to middle school, I started earning a couple $100 a week, basically. And what I would do is I would walk to convenience stores across the street. I would buy things like Cinnabons. I grew up in a tough neighborhood, so anything that would provide a lot of calories to kids, they would buy it in a heartbeat. And
course. Well,
so
Cinnabons are just delicious, and they're
I know,
filled with
I know.
sugar and cinnamon. They're meant to be. Forget the calorie count or whatever else. It's just like they're delicious and meant to be like addictive to anyone
That's
who
right.
enjoys tasty desserts.
That's
Hold on,
right.
before we get to finish that story, since I just interrupt you there, I do have to ask: were your parents, or at least your father, was he a first generation immigrant? Okay,
Yes.
so that's a general story you see with a lot of founders. Of course, is
Sure.
they have relatively near in their background someone who was an immigrant.
Yeah.
So was he wherever he came from? Did
Yeah.
he have a similar? Did he? A lot of times people have like these amazing, impressive backgrounds. They come to the U.S. and they have to almost start from scratch, doing things that might feel below them if they
Yeah.
were in their other country.
Yeah. I mean, I don't think he ever looked at anything that was above him or below him.
It's
It
great.
was just kind of like, I think that, I don't think that ever crossed his mind. It was kind of like his way of making ends meet. And, I think as a father figure, he did the best that he could. And I'm extremely grateful. I mean, he's one of my role models, right? Because he never complained. He just worked really hard, and 15, 16, 17 hours a day did not bother him or annoy him. I mean, there's a lesson to be learned there, right? So in any
What
event,
sorry, what is that lesson, right? What is the main lesson you take away from your dad in the amount of time he was willing to work? Not, I mean,
yeah.
I love like not seeing anything's below him, just working.
Yeah. First and foremost, like not complaining about your source of living. I think a lot of us take pride in what we do for a living. I think there was some attachment to the work that he was doing, but it wasn't like, you know, he wasn't thinking as much about next year or 5 years or 10 years down the line. It was just about making, rent and paying bills on time. He also, didn't believe in using credit cards, and we had some issues around his credit profile. So basically, we grew up in a tough neighborhood because we didn't qualify for a better neighborhood to get an apartment there because their credit requirements were 700 or up or 690 or up, and
Yeah.
he was well below that, right? When you're young, you're not thinking about those things. I certainly wasn't. Well, what I did know from an early part of my life was I was the oldest in my family, and I needed to make ends meet to the best of my ability. And it started with me looking inward and saying, how can I help myself? And then how can I help my family as time goes on? And that kind of became part of my DNA. I don't complain when things get hard, things get easy. I try to remain fairly stoic in my process, not getting too up or too down. But yeah, man, I mean, buying candy, gum, Cinnabons, whatever I could get my hands on, buying stuff for 25 cents, selling it for $1, 50. I mean, literally at age 11, I'm talking about 80, 75, 80% gross margin profile of, just kind of hustling my way through, getting into high school, selling, shoes and, football jerseys, basketball, like whatever I felt like I could properly sell, I would do that. And
And
I didn't have,
how would you even identify? I mean, I know this a long time ago, and it seems sort of silly, but like, how would you almost identify that market, right? It's like, hey, like presumably other kids have easy ways, maybe not easy. They have ways to get Cinnabons or ways to get shoes. So why was Faheem the perfect salesperson, perfect vessel for their sugar high or their ability to run around or look cool?
yeah. So a couple of things, right? I think what people actually end up craving is convenience. So they couldn't, in the neighborhood I grew up in the school, like you couldn't just walk out the school and buy the Cinnabon or buy the candy or you weren't even allowed to chew gum in school. It was that type of it was that type of a setup, right? You had to wear a school uniform and the whole thing. And so it was just a convenience factor. Like, do you want it or not? Right.
So how are you able to get the Cinnabons into school to do that? I mean, you can't like hide a big box of Cinnabons in your backpack.
Well, but you can individually take Cinnabons because they're fairly flat, and you can put them in your backpack, right?
You like
Yeah, so
wrap them
yeah,
individually.
yeah, and you don't need 55 Cinnabons. You're smuggling Cinnabons into a school. You're not taking like 75 or 100 Cinnabons and trying to you're taking 10, 15, whatever you feel like you can sell, and at $15, $20, $30 of I'll take that, right? Because the cost of that is, $4, $5, $6 or something like that. So
Was there a risk that you ever like were worried that somebody would get mad by this and like tell the teachers that you were sort of illegally selling Cinnabons at school?
yeah, I mean, I've been suspended a few times, and I got in trouble a few times, and I would always try to finagle my way through it. But yeah, I mean, I was considered a rebellious kid because I'm doing something I'm not allowed to do. But I didn't think it was anything wrong selling, chocolate, candy, gum to other students. I'm not selling anything illegal, right? So
So that was actually going to be a question that it almost feels like I have to ask. It'd be remiss if I didn't ask, which is like, this story is one I think a lot of drug dealers might say too. It's like, I just needed to make money for my family. I started bringing in a small amount of things to school because that's where the market was. It was convenience. In some ways, it's all the same. You're selling sugar. You're not selling drugs. And maybe that's the line. But what do you think it is that enabled you to kind of head in the, I'm only going to sell sugar high stuff and end up where you are today versus people who go a little bit in a different direction? I mean, what was that dividing? Was it from your parents? What
yeah,
kept you on just barely on the right side?
I still don't think they know.
Then they listen to this and find out and have a good talk for the holidays.
I also, candidly, I don't think I was thinking very much. I wasn't sitting there.
Most kids aren't, right? You're just like, I need to make money, and it's
I'm not thinking about what's my total addressable market inside of this school. Do I sell to sixth graders, seventh graders, eighth graders? Am I even selling sugar? I didn't think about that. In fact, I would argue I was selling calories, if anything, right? So like a daily intake of like a kid in middle school is 1,800 to 2,000 calories a day. And guess what? They're coming from single family households, and there's caloric deficiency on their side, right? So they have no problem paying $1.50 for 800 calories. You know what I mean? Like,
Yeah.
I don't think that the kids were thinking as much. I certainly wasn't. I felt like if someone wanted to buy a product that I was selling, then it makes sense for me to explore what that looks like. And I would toy around. It was, I would buy shoes for like 45% off, 40% off, and I would go and sell it at market to the students, right? And so whatever I felt like there was a market demand for that felt practical and that I had an interest in some capacity. I grew up playing a lot of competitive basketball and competitive sports in general. So soccer jerseys, football jerseys, basketball jerseys, Air Jordans, Nikes, all of that stuff, like just felt like I'm good at it. I have to do it. And that's what I got to do. And then when I got to, I think 10th grade, I stopped doing that. I got a job at Quiznos making subs.
Good subs. Yep.
Yeah. And then in 11th grade, I started working at Old Navy and Quiznos. So you can imagine I was, Monday through Thursday, I'm working, Saturdays, I'm working. I struggled in high school, and it wasn't because of aptitude. It was just because I went down a path that I went down. So I actually started my journey at a community college because I didn't qualify to get into any four-year university. My GPA was that low. I graduated at the bottom of my high school class, believe it or not. But again, had nothing to do with aptitude. It had everything to do with just priorities were different. So yeah.
So what was the switch that flipped in a sense that said, you know what, I need to redo my priorities? Because I'm sure something to be said for having extra money in your pocket, helping your family out. Those were your priorities, it sounds like, in high school. What flipped in your head that said, you know what, I need to figure something out. Otherwise I'm going to be in the same jobs as my dad and take that exact same path. Like what changed to now have us on this call working from our nice little, our home offices and stuff? Like something changed, right? What changed in it sounds like community college timeframe?
Yeah. I mean, I think it was senior year of high school, notably. And I just focused on, I think it was just a moment where I realized that in order for me to create massive value for myself and my family, by the way, I had no attachment towards, like, I don't judge my father's work. I don't judge what anyone does. I could very well, in an alternative universe, I could be doing that, right? But to me, there's no like judgment associated with any form of work, whether it be janitorial or being working as a barista. To me, as long as you're earning an honest living and you're being a good person, that's what's actually important. So I don't know if I paid too much attention to, I don't want to go do the work that my dad is doing. I don't think that crossed my mind. It was mainly just sort of what I call intrinsic and extrinsic motivations. So seeing some of my friends in high school, particularly senior year, get into like Harvard and Rice and UT Austin and just top institutions, and I was like, man, like there's just an ego hit. Yeah. And I was like, that could be me, but it's not me not because of my attitude or aptitude. It's just priority shift. And so when I got to community college, got a 4.0, just focused my energy all the way in. And then as time went on, and I did a summer business scholars program at University of Chicago. And that was kind of a moment where I realized what a top institution looks like and what it means to kind of get out of the house. eventually went through my process and got to UT Austin. I was studying mechanical engineering there. And then, 2.5 years into my engineering sort of coursework, I decided that my passion's actually in business, as I knew. And so I'm going to go and declare economics as a major and bolted on applied math as a second major, because engineering, you take enough courses. And now what I will tell you is I forgive, but I sometimes don't forget. And I vividly remember in senior year of high school, I was in a pre-calculus class, and I was struggling with a packet that all of us were working on. And I remember my math teacher came in. I still remember her name. And she said, Fahim, in order to graduate from high school, you have to know 2 + 2 is 4. And everyone kind of chuckled a little bit because I was struggling with a packet that they were breezing through. Mind you, I was behind, right? Because I'm doing all this catch-up work in senior year, and these kids are they've already done the coursework. So I didn't understand algebra, let alone I'm in pre-cal, and these kids are in calculus. And I was like, when I was declaring my math major, I was like, one day I'm going to go to my teacher and say, I know arithmetic, but I majored in math.
Yep. That's so great. Have you talked to her?
I haven't. I need to go back and give her my well wishes.
Yeah, you should. You should almost like, I didn't appreciate the comment really at the time, but it actually gave me the fuel to fire, the fire that has taken me where I am today in a weird way. Thank her for that.
I'm grateful. I'm grateful for that comment. I had this so I grew up I grew up playing basketball, as I shared. Big Kobe Bryant fan, and you can see it's a signed kind of Kobe flag in the back, but kind of just using any fuel I can get to push my way through. I mean, it motivates me, it inspires me. I never look at criticism or constructive feedback as a bad thing. I think it's a gift. I mean, I'm appreciative of that conversation. She probably doesn't even remember, but it fueled me when I was declaring my major. It fueled me.
Do you think, I know I'm going to jump ahead a little bit right now. I mean, you're an investor in your own firm. You've worked with a huge number of amazing entrepreneurs.
Yeah.
Do you think a lot of them share or have different, like similar type stories to you when it comes to there's something that's fueling their willingness to work that hard, their willingness to try new things, like the things that pushed you to where you are? Because once again, you could have easily gone in a different direction, right? You could have not let that fuel you and just say, oh, whatever, like that's silly. I don't like this person, this teacher, but it did fuel you, and it probably still fuels you in some ways. So like, what do you see across other entrepreneurs, as well as what are some of the driving or motivating factors that they share, the really most successful ones, and we can define that too. But
yeah, well, look, I mean, I think there is an objective way to define who a successful entrepreneur is, and I think you can look at someone's track record and commercial success and see their ability to create enterprise value. Anyone who disagrees with me, I'm happy to have a conversation. But if you're an entrepreneur and you're a founder and CEO of a business, you have to be a good steward of capital, and the way you gauge performance is what kind of value have you created in the market, right? So I think there's a way to gauge that. I think that's a good question. Here's how I would kind of angle it, which is a superhuman ability of the best entrepreneurs I've worked with are typically twofold. There's a sense of urgency to get things done, and there's like relentless steadfastness. Like they don't really they can tolerate a lot without giving up. And I'm not quite sure if money is the only motivator. I think money plays a role, but I think they're kind of like they want to perform for their shareholders. They want to perform for their employees, for their customers. I think there's a part of them, they're just wired a certain way. Now, do they come from the same backgrounds? I can assure you that when I look at my portfolio, whether it's on the investment side or on the client servicing side, there's probably not a ton of overlap between where I come from and where others might come from. That said, I think therein lies the beauty, because I don't think that you have to come from a certain background to become a successful entrepreneur. You can come from any background as long as you've got the right kind of headspace mindset to drive value in your business.
How do you identify that mindset when you're, from an investing perspective? How do you identify that mindset because every entrepreneur is going to tell you, if they're any good, they're going to tell you a good story about why they decided to start their business, what's fueling them. How do you cut through the noise and really get to the meat of who this person is? Is this someone I want to back with my money and my time?
Yeah, it's a good question. I think it depends on the stage that you're getting involved in as an investor, right? So typically at the seed level, you're looking for what I call founder product market fit. You want to make sure they've got the right team to drive product market fit. As you get into Series A, you're really looking at product market fit. Series B, how do you scale that fit? And then, and beyond, right? So in today's kind of venture capital space, you've got pre-seed, bridge A, B minus. I mean, you got all these kind of interesting bridge rounds that kind of come about, but let's just kind of bucket them in seed, A, B, and C for the sake of discussion. I've always believed that good founders will find their way to get into the room, and people that end up closing the round or closing on metrics. So I like to underwrite metrics. So I appreciate what a founder shares from their story standpoint, but I like to look at the world from an objective lens. So I like understanding, what the MRR looks like, ARR looks like. I like to understand conversion rates. I like to really understand the financials, because that's where I come in. Is where I think I thrive is helping founders make capital allocation decisions to then build enterprise value, right, over time. That's what I enjoy. That's what I think I might be good at. And I can't really do that when someone is just pitching me a story, because I can't go and sell a story, right? So that's what I think about, agnostic to check size.
Okay. So you want to find ways to basically bring value beyond obviously just money, which is, I think, the right thing good investors do. Is like, how can we help them and understand, especially the financial part, what they're doing.
And maybe for context, like, I don't have a large fund of any kind. I'm not deploying capital on behalf of other people. It's not a GPLP structure. It's, I write very modest sized checks, and my commitment to the founders is smart capital. I don't invest in every company I talk to. I invest in very, very few, and I want to be helpful in the process. And that literally can stem from hiring and firing and org chart design and EOS and the traction model to the next fundraise, or looking at the financial metrics and making certain decisions, or wherever founders need help. I say, call me guilt-free. Like, I'm not a lead investor. I'm not an institutional investor. If my $20,000 check goes to zero, not good, but like, I'm not getting rich or poor because I invested in your business, right? I'm doing it because I believe in you and I want to support you, and I want this business to thrive and succeed. And so that's how I typically would position it.
And how often do you find yourself investing, or maybe not at all, in your clients as well? Like, is that a thing? Like, in a sense, you have extra insight into these clients. You probably are helping them do their fundraise. How often do you participate, or not at all? And I'm asking this for a purely selfish reason, right? Because I have my company, Levy, and we do client services as well, different than you guys. And I also have a fund, and I've been doing investing for almost, 11, 12 years at this point. So for a really long time, and I enjoy it. But what is the line there? Do you have one where you say, hey, like, we have unique insight, and data arbitrage or knowledge arbitrage is how you can make real money, because you actually have that unique insight. Mm-hmm. Do you use that? Do you not use that to make these investment decisions?
Yeah. So yes, I am an investor in a handful of companies in our portfolio at Finance Within. I don't typically look from a lens of, do I want to invest or not? I think when the opportunity becomes very obvious, then I'll explore it. But I don't lean into it from a lens of, oh, I want to invest in this business or not. And on the contrary, the opposite has happened, where I've invested in a business, and as they're starting to grow, they need to professionalize their finance and accounting function. And that's when they're like, Faheem, can your team help us out with this? And so then we'll bolt on our team. So it's kind of worked both ways, but I don't operate from a lens of like, I need to be an equity player in order for me to create value on the services side. When it works out, it kind of works out.
Yeah, no, that's generally how I feel about a lot of our investing as well. So I kind of want to keep following your timeline, but I also kind of want to jump ahead, because we're already sort of on that topic. Like, tell me more about Finance Within. Why did you start it? Why did it make sense? Who do you help? What does that look like? And we'll dig into that a bunch more.
Sure. Yeah. So I'll maybe tie some loose ends from the post UT to now, which is, throughout UT, I worked at like early stage companies, by the way, never worked at a large business. And so I've always had the entrepreneurial bug.
Well, hold on. I know you worked at Facebook, and I know I read in your blog post that you worked there when they were like 8,000 people. That was I know they got to like 30,000 people in your tenure, but like, that was still a big business.
Yeah. I think when I got there, it was probably closer to 4,500 or something.
That's still a big business, right? I mean, that's like a lot of companies. What percent of companies that are publicly traded are even that big, right? I mean, I'm sure a decent number, but not that many either.
Yeah. Yeah. And, Facebook was a terrific experience. It was a rocket ship, and it got to like, I think when I left, it was like 17 or 18,000 people. Today, it's probably over 60,000 people.
Okay.
So it's just, I mean, it's a magnificent business for a reason. But in any event, when I left Facebook, I started a digital consulting firm doing a lot of like
Like,
performance
why
marketing.
did you leave Facebook? Since we're going back to that, like why did you leave Facebook, right? So there are plenty of people listening today who might say, I want to become an entrepreneur, but I have either a family or I just have a really good, solid job at one of the best big tech companies. It pays me well. I work hard, but maybe it's not crazy. Why take the risk of leaving that, especially knowing that you probably could help your parents out? Facebook was doing well.
Yeah.
It seems like a really safe place to be for a long time in your career, and
Yeah.
yet you left to go start something new.
Yeah. That's a good question. I would say that I remember interviewing for a role in the Facebook marketing partners team. Basically, they help technology players that are using the Facebook API to help them grow and scale their business. And when I was interviewing for that role, they wanted a higher IC level than the IC level that I was operating at. And I said, well, I understand, but I can do the job. And they felt strongly that that's like a non-negotiable. And I said, okay, understood. And that was kind of a signal to me that the company is kind of outgrowing, like the company is getting red tape in place now, right?
Yep.
Because when I joined, when I know we're saying 4,500 people is a lot of people around the world, given the scale that Facebook was operating at, actually it was quite small. It was like a startup with public company offering essentially.
Yeah.
You could like, if you were nimble, you could like merge your way through director level relatively soon and quickly. And so when I started observing, that was interesting. And then when I had my performance evaluation, I did very well objectively. I mean, they gave me a book of business that I grew by almost 4x in advertising revenue. And just it became clear I got passed up for a promotion. And that became really clear that the company is going in a direction that I just know that this is going to take a long time to get to where I want to go. And I remember when I was leaving, I told myself, one day, if they didn't want me to work on the FMP team, I'm going to become an FMP.
What is an FMP? How do you define it?
Marketing partner. And this goes back to like fueling the fire.
Yeah.
And Facebook was extremely kind. I would never ever talk badly about my experience. It was, when I was there, it was fantastic. I mean, it was one of the best experiences I could have asked for. Some of my close friends are still from that time that we worked together. In fact, one of my best friends is still I met him there, and we talk often. So
what are the things though, one thing that I find fascinating for a lot of businesses, even when they're much smaller than Facebook, right? As you get bigger, at every sort of stage, you sort of add new layers of management, red tape. You hopefully try to avoid as much of that as you can as you grow. How do you advise your companies to deal with that, right? So, I mean, I can imagine trying to put myself in the shoes of the people hiring for that role that you were applying for. Maybe there was a legitimate reason to say, we have to have a hard rule to say, this person needs to be at this level. Otherwise, we break other restrictions that we have, or we need to pass Faheem over for a promotion because there's 10 other people who are just as good, and only one of those 10 can actually be promoted. And Faheem's great. He's not quite as good as this other person, or maybe he didn't play politics well enough. Like, I don't know, but like, what are the, in their defense, what are the things you think they were thinking about, or what would you have done differently were you in their shoes?
I think they did what they thought was best. I have no hard feelings towards the process. I respect it. But to me, if I can't win the game, then me trying to change the rules of the game at that stage level, at that level, just was not going to be a productive use of my time, right? And so I knew that I could try to carve out my own path offline. And I've never been afraid of taking risks. Like, I have a pretty substantial risk appetite, and it's not because I'm a rebel, but it's because I know how to underwrite and manage risk. And so one way for me to manage it was keeping really good contact with my team at Facebook. Like, in fact, when I was leaving, one of the VPs came and said, open arms. If you decide it doesn't work out, come back. Like, no hard feelings, no issue. And so to me, if someone's going to offer an insurance policy to me to go and experiment, why in the world should I not experiment? So I think a lot of people would underwrite that as saying, oh, you're taking a big risk. And people that didn't know, they're like, you're taking a big risk, you're letting go of stability and et cetera. And I didn't think it was a risk. I just didn't feel that at all. I knew that my skill set was marketable to begin with. So if it's not Facebook, it's Google. If it's not Google, then it's Snapchat. Like, I could find a job, at the end of the day. So that I wasn't driven by that. I also felt like in the maturation phase of an individual contributor at a large company, you start to reach inflection points in your career where there's a diminishing return on your learning. And that's a moment where you have to kind of find your buoyancy and kind of peek your head up and catch your breath and say, am I learning? Am I growing? Am I creating value? Am I part of a like it's really a moment of reflection where you have to identify that and think of it as like what I call high performance S curves. So every time you're reaching the inflection point of an S curve and you're getting ready to jump on the next S curve, you have to take that moment to reflect. I found that to be really, really helpful and to some extent powerful. And the decision I decided to make is instead of me continuing on the path of trying to get, play the game. And by the way, I did get promoted relatively quickly initially. And so it wasn't, I think part of it was my fault because I thought I would get promoted again within 6 months. And it's not Facebook's fault for not promoting me 6 months later after I had just gotten promoted, right? So I can't blame them, but I also appreciate the fact that I just had this relentless drive to just go, go, go without like recognizing the gravity of the situation.
So a few things. I mean, one, it's such a hard scenario because we've gone through this ourselves at my company, where you want to promote some people quickly because the company's growing fast. They maybe were under-leveled to start with, a bunch of other reasons. Then suddenly you set this weird precedent. And sometimes people have this expectation like, hey, like things have changed. We're a different company than we were 6 months ago, or it wasn't. In dealing with that is difficult. Question then going back to the S curves and kind of that inflection point, what is your advice for people to identify that inflection point? I don't think everyone is as reflective as you are. How do you advise people to think through, like, this is an inflection point, think through this deeply, and then think through, do you have an insurance policy? Because I would argue almost everybody does. They might not view it that way. And maybe it's not as obvious as what you got from Facebook, but if you're good at your job and you leave, people should cheer you on and give you that insurance policy. But of course, it's predicated on being great at your job. But it's like, how do you think through those inflection points, and what advice do you give people?
Yeah, I often think about it in terms of like my contribution to the organization as well as what I'm learning. So a good friend of mine runs a sort of a human consulting firm. Basically, he helps founders and CEOs become better human leaders and people leaders, right?
No, coaching, executive coaching, basically.
Executive coaching, right? He and I were having this conversation about what he calls employee value proposition, EVP. And his name is Wes Adams. So I implore anyone to check out his work. He's terrific. And basically,
what's the name?
Wes Adams.
Wes Adams. Okay, got it. Sorry. Yeah.
And so he basically he qualified what he calls 3 C's of meaningful work, right? Which is contribution, community, and challenge. Okay. Contribution is the work that I'm doing. Am I helping my colleagues, my team, my company, my clients, my customers, et cetera, right? Like me contributing in a positive manner. And does that fuel me? The second is community. Am I in a supportive environment where I can continue to push the puck forward? And then challenge, like I want to feel like I'm learning and I'm growing, and that learning and growing is supported within my, from my leadership team and from my peer group. And so an inflection point is when you typically have a moment every 6 or 12 months, kind of reflect on your 3 C's, right, is what I say. And I think that's a good kind of time cadence. So the way I always think about the independent variable, imagine like an X and Y chart, independent variable being time, and then dependent variable being the 3 C's. And then kind of create like basically a bar graph on how you feel on the margin, how you feel against each of those. I think doing it anything shorter than 6 months might even be too frequent, but like every 12 months, I think that's a really good time to do it. Another exercise that I actually learned this when I was at Facebook, it's called fast forward. And Facebook used to call it F3, Facebook fast forward. And so typically every December, I fast forward to the following December and I write down everything that has happened. So
it's
I'm
like
writing
pre-retro. It's pre-retro is the wrong term. There's official terms for it, but like you're thinking through what's going to happen in the next 12 months.
Yeah, but instead of saying, I want this to happen, it has already happened. So when you document from a perspective of past tense, you're recording it from that lens, right? And so that becomes really powerful. Yep. It doesn't need to be like a long essay. It could be bullet points. These are my personal, professional, spiritual, intellectual, physical, whatever, right? You have goals.
You keep that confidential to yourself, or you share that with your manager?
I prefer to keep it confidential because it allows me to just have a more It allows me to have raw thoughts built into it. What I have found is when you try to socialize it, you're really catering it to your audience. And so, yeah, and then you get into the mindset of how do I cater it to someone's liking versus what's important to me.
Right.
And you have to understand that when you're writing it, maybe your fast forward includes no longer being at this company, right? Like exploring a new job, or, I'm starting a new role as a director of finance at XYZ company or type of company. Like, you don't want your manager to know that, right? That can feel, silly. And so to answer your question explicitly, doing a fast forward and then doing that kind of 3 C's calibration every 12 months or so, I find to be interesting and helpful. At a minimum, it validates your decision on where you are and what you're trying to do. So it creates intention. So I think that's valuable. And at a maximum, it allows you to action where you're trying to go.
Do you still do that today at Finance Within? Do you do the 3 C's in fast forward?
I do. Although fast forward, yes. Although my 3 C's they've evolved, right? Because my contribution is going to come down to how many founders we can help. My contribution is going to be how many jobs we can create, how many companies we can help secure capital. So I think it's evolved. I think where my 3 C's come in is how do I create the 3 C's for others? So I think part of my 3 C's, part of my contribution is how do I create the best 3 C's for my team, as an example. So to answer your question, yes, but it's more revised.
Makes total sense. So okay, you decide to leave Facebook. You did your fast forward. You're like, I don't want to be here right now. They're not promoting me as fast as I want. I'm not super worried because I have this insurance policy in the back of my hand, which is, once again, I want to kind of re-emphasize that for so many people, that it's so easy to get held up by fear. But anyone listening to this is already living a privileged life where you have the opportunity to listen to podcasts and learn from interesting people. And that already means you have some sort of insurance policy, which is the world's knowledge at your hands and the ability to learn and work hard. And if you do those things, I think anyone will get a job if they want it. And so there's, in a sense, always an insurance policy, and the risk, this is my own biases, but the risk is always worth taking if you believe in something passionately. And it sounds like you did. But so how did you have this idea for, I guess, what became Social Within? How did you have an idea for that? Why did you say I'm going to go? Or did you even have that idea when you left Facebook? You're just like, I need to leave and clear my head of the nonstop work at Facebook to even come up with an idea. I just know I don't want to be at Facebook anymore.
Yeah. And, I think the topic of like what I'm passionate about comes up often with other entrepreneurs. And, I don't believe in that. I don't think that, I think passion is important. I think what's actually more important is contribution. Like, if I have an ability to help others and I'm good at that, and I can do that at a high level, like at a strategic level, at a deep level, at a high level, etc., kind of capturing the 4 squares, then that becomes my passion. I mean, you know what I'm saying? Like,
I know exactly what you're saying. Yeah, no, I'm smiling. Some people listen to this, right? So, and the reason I'm smiling is because this is very much on theme with my own personal belief, which is your passion becomes what you're good at. What you're good at is something that you've worked hard at. And then you start to get those accolades because you are good at it. And the next thing you know, that becomes your career and your passion. I think it's very rare for someone to fall into it and be like, I love this. No, you fall into something because you might have an interest in it. Like, clearly you have an interest in math and finance. Okay, great. That started to become your job, and then you built from there. Yeah. But it became your passion because you're good at it. And because you're good at it enables you then to continue to fuel that passion and then lead to amazing outcomes for your team, for your family, for everything else. Yeah. It all builds on itself. So yes, exactly. I'm totally tracking with you.
Yeah, exactly. You nailed it. And so I think the kind of 30-second version is when I left, I didn't really know exactly how things were going to play out, and decided to form this company called Social Within. I saw what other agencies were doing when I was at Facebook. They were charging an arm and a leg to drive what I thought was suboptimal performance.
And you were working with them at Facebook on the Facebook side, and they were like your business, your customers in a sense, almost like, so you kind of had that insight because you were working with them from within Facebook. Is that sort of how you had that insight?
So I was more directly on the client side, but the clients were being serviced by the agencies.
I see. Right.
So Facebook, if you work at Facebook, you're not allowed to manage media on behalf of clients because just errors and omissions, et cetera, those issues can pop up. But I saw the service level that was being provided, and it's a fairly commoditized ecosystem. So clients would go from one agency to another to another.
Oh, wait.
Anyway, so social within started to get built out. We, you know, I knew the e-commerce D2C space quite well. I've been kind of toying with it for a number of years. Even prior to joining Facebook, I'd been playing around with some e-commerce opportunities on my own side hustle. So I've always kind of been involved one way or another in e-com, retail, D2C kind of space for since 2008, 2009 in some capacity, informally. But when I got to Social Within, we really just focused our energy on working with consumer product brands to help them grow and scale. Work with some really, really cool brands, like some of the internet's hottest companies. And, yeah.
What was the unique insight with Social Within though? Like what made it truly differentiated from the other vendors in the space?
I think, look, in my experience, there are two reasons why an agency wins. And I haven't worked in an agency capacity in a couple of years now, so this was what worked then. But I suspect it works now. I think you win in two ways. I think you win on service and you win on technical competency, right? So people want to work with people that know what they're doing and that can communicate what they're doing, and clients feel comfort in that. Results can sometimes be sporadic on digital platforms. So, you may have a good day and a bad day, but you want to make sure that the pilot flying your plane is competent, not incompetent. So, it's like when you have a ton of turbulence on your flight and you don't hear from the pilot, you assume the worst case scenario, right? It's like, wait, that means there's a lot more coming ahead and the pilot's not communicating with us. So when turbulence comes up, when you're running media, you want the pilot to be able to communicate. So to me, it comes down to technical competency. Can you fly the plane? And communication. So when things are not good, you can let people know. I think that's what, honestly, like, I can try to boil it down to like those two things is what helped us win. I can get into the mechanics of other things that are probably more pitch points and sell points, but by and large, that's kind of the inside baseball: is provide good client service, care about clients, help them win. Their success becomes your success. Like, alignment in that is important. Communicate openly and honestly with high integrity, and then try to do your best work when you're in the platform and like doing your thing. And that really allowed us to kind of shine. And that led us in, around 2019, I was getting tapped by a couple of larger agencies to bolt on as a company that they were interested in acquiring, and ended up joining a business that acquired us, a large agency out of South Florida, a great company. They acquired us. I transitioned in as their chief strategy officer. My employees kind of rolled over to becoming a full parent company, part of their platform. And that was a terrific experience. They were a much, much bigger firm. Got a chance to kind of see how, private equity backed businesses run, and really got a chance to see how a professional services firm at a much larger altitude kind of operates. And in 2021, I took a step back because in the maturation phase of a business, you kind of become a general manager at some point. Nothing wrong with that. I just wanted to spend more time working directly with founders and really getting back to getting back to being an entrepreneur. And in my process from like being a CEO to being a CSO to having gone through M&A and et cetera, I just realized that a lot of founders, Adam, are good at product, marketing, sales, engineering, people. Finance and accounting it's an acquired skill set. Let's talk about, right? You have to learn that over time. And I've always felt like I was good at capital allocation to drive value. Like, that's what I enjoy doing. And so that's kind of where this business started. And Finance Within today, I mean, our kind of 20 words or less is, we're here to build investor grade businesses, and we want to help our founders grow with confidence. So we primarily work with consumer product brands, but certainly work with some other categories as well, software, et cetera. But by and large, working with founder-led companies across three service lines. There's transactional advisory, there's financial FP&A and financial operations, and there's accounting. Transactional advisory is sort of bespoke. It's, M&A support, corporate development support, governance, compliance, fundraising, bankruptcy, things of that sort in FP&A. But, again, very sort of bespoke one-off engagements. Where the rubber meets the road for us is on FP&A and accounting. On the finance side, it's a lot of technical modeling, pro forma, financial projections. It's like contract reviews and insurance review with clients. It's sort of cash flow forecasting, it's working capital advisory, it's treasury management, things of that sort. And then on the accounting side, our goal is to make sure that the financial reporting is bankable and defensible. And so for a number of clients, we do their month-end close and put together really robust financial packets with supporting documentations so that founders can kind of track how things are flowing.
So many questions I want to ask right now. Maybe for a few minutes, we'll stick on finance with him, but I want to come back to some of the acquisition stuff too, because I think that's a fascinating topic that's not talked about a lot. But you mentioned like you think that it's critical for founders to understand the finance piece, yet at the same time, you started Finance Within. So the question is, does a founder really need to understand the finance piece, or should they just hire a fantastic financial firm or outside or CFO or someone who really actually understands it? Because as a founder and as an individual in life, it's not even a founder, you probably can only be good or arguably great at one or two things. Everything else, you almost should be hiring people, I think, to take care of that stuff for you. So like where should a founder understand finance or say, I don't need to, I'm going to hire Faheem?
So this conversation go in many directions. I'll answer your question explicitly, but then I think the kind of tangents here to explore are, when should you hire in-house versus maintain kind of an external partner? This can also lead into what's the level of advancement or like what's the level of understanding of the functionality of the business as an entrepreneur, and how deep should you go into marketing or finance or ops, etc. I think all founders should have a baseline understanding of their accounting. I think they should have an elementary understanding of their finance in the early stages.
How do you define elementary understanding?
They should understand what the difference between cash and accrual accounting. They should understand what the difference between cost accounting and financial accounting on a GAAP-friendly basis. They should understand their balance sheet. I can't tell you how many times founders just look at the P&L and don't spend a ton of time thinking about their balance sheet. So understand your balance sheet. Because, by the way, because the balance sheet is sort of like a Kodak moment. It tells you how your business is doing at a period of time. Your P&L is more like a movie. It tells you how your business is doing over a period of time. So you want to know how your business is doing today, look at the balance sheet. You want to know how your business has been doing over a period of time. Okay, so that's how I think about that. You want to understand things like free cash flow. I think those things are important. You want to understand things like working capital management. More importantly, like, because that gets into capital allocation conversations, right? Should you buy, let's say you're an apparel business, what's your optimal level of inventory? Is it 13 weeks of supply or is it 66 weeks of supply? I hope it's not 66, right? Because then you're tying up all that capital into inventory, which doesn't feel right. But if you don't have a strong financial acumen, or not even financial, I think business acumen, you're going to make certain decisions that actually hurt your value than increase your value. So I think having a baseline understanding of that stuff is important. And then being able to communicate it with your relevant shareholders. I think that's really important. A lot of times I see founders not even properly understand what their contribution margin is or what their current ratio and quick ratio look like. They have a vague understanding of their cash conversion cycle, but they're not fully dialed into it. And so I think that, to me, that's like table stakes. Once you understand that, then you can take that and start making strategic decisions in the business. And then you get into other stuff. Like, what I don't encourage founders to do is don't build your own models. I think you should understand your accounting, have a vision for the future state, and then have someone in finance build pro forma, essentially, that sort of quantifies and so what the future state of the business would look like.
At what point should founders get a model in place? And I say this because it's actually a mild pet peeve of mine, where almost every customer we work with today and every company I've invested in, they basically don't get a model until sort of late in the process. In some ways with good reason. It's annoying and frustrating and hard to build a good model. And most CFO firms, in my mind, are overpriced for what they deliver. And they end up delivering you an Excel spreadsheet that only they can ever manage and deal with. And it becomes an expensive, time-consuming, low ROI effort. So founders just avoid having any sort of real model. Hopefully they're doing their books. We kind of require that with our customers. They basically get at least their books done because they got to pay taxes, and that's like basic level, and you can get that done for relatively low cost. So when should someone get a model in place? When should someone be hiring someone to help interpret that model and think through it beyond just, I'm going to plan, my investors are asking me, what does my revenue look like 12 months from now? I'm going to say we're growing 5% month over month and let it compound. And that's my model, which maybe is all you need early on. But when should people start thinking more deeply about getting a real model in place and then even hiring someone to actually help interpret and update that model?
Yeah. The moment you understand your drivers in the business is when you should build a model. I think a lot of founders in the very early stages don't fully understand, or if they understand, they can't articulate their drivers. So like an example is if you're a software business, marketing drives revenue, right? That makes sense. In order a bottoms up SaaS company, right? Or in a consumer, in like a D2C brand, marketing drives revenue. Revenue helps influence inventory buying decisions, which then helps influence working capital needs, which then helps influence liquidity planning, which then helps influence liability or equity raise, whether it's debt or equity, which then helps us understand what the balance sheet will structure out to be. And you can kind of see that cycle flow, right? But if a founder doesn't fully understand what their drivers are in the business, then that, or maybe they're not practical and like they're not being pragmatic. It's like, oh, we're going to get a $20 CAC at 5% conversion rate, steady state, and we're going to grow exponentially. That's just not practical. Anyone that sees that would give it a pretty hefty haircut. Yep. So I think once you understand your drivers and you want to start to solidify sort of your vision in a quantitative way, I think you should start to build out your model. Question really becomes is how far out should you go, right? Is it 12 months? Is it a year? Is it 5 years? And I think that's just contingent on what's important to you. In my experience, very early stage companies typically would end up having like a 3 to 5 year sort of forecast built out for the sake of a fundraise. But there are just so many things that can change. It's a very dynamic sort of situation as accounting starts to actualize the results. And so what starts to happen is you end up having a really large variance from budget to actuals because the process of building a model, and I think the reason why you feel like it's a low ROI effort is because a lot of founders treat the model as an operating plan. And I think that's the wrong methodology. I think a model is a financial exercise that tells you how your business may do in a future state. It's basically taking historicals and moving them forward. Or if you're pre-revenue, then it's really an idea that gets forecasted out. So it's partially a creative exercise for the founder. But the model has to get transposed into an operating plan and an operating budget. Yep. And I think and so when you don't do that, and then what you end up finding is updating the model is just adjusting the historical accounting and actualizing the data and then catching the variance across your key financial statements. And so when you're doing that, you're like, oh, we had a 50% variance in our marketing spend or in our revenue, and revenue was up 50%. So the model is wrong. The model isn't wrong. It's when the model was built, that was the input that was provided. And so the actuals have exceeded expectations, or other way around, we overshot what the future state would look like instead of being more practical. And so transposing the model into an operating plan, and as the business continues to evolve, maybe consider reforecasting every quarter so that think about the finance within value. We call it finance within value index, which is we care about three things: growth, profitability, and predictability. And I'm a big Buffett fan, so I've got all of his, in fact, in that book, I've got all of his letters in there. And he talks about like being a value investor. Yeah. And so productive assets in today's market, and really in any market, are sort of predicated on those three things: growth, profitability, predictability. Try to get your growth. Profitability is very obvious. I think it's important to kind of dial in the nomenclature. Like, what is growth? Is it 5% month over month? Is it 10% year over year? Like, allow yourself to sort of qualify what growth means to you. Same thing with profitability and what that looks like, whether it's adjusted EBITDA, or is it on a net operating income basis, or is it a net income target that you're chasing? But really, or is it a contribution margin goal that you're chasing? Not that that's profitability, but bottom line is really understand your margin profiles in the business. And then from there, dial in the predictability, which is what I call, if you're a small kind of SMB startup or like lower mid-market, you should be kind of in the plus or minus 10% variance as you're growing the business. And as you get into like 20, 30, 40, 50 million in revenue, your variance should be plus or minus 200 basis points, right? So that you have more predictability as you're growing the business.
So all that sounds like good on paper, but part of my skepticism to some extent is you see all these big companies, public companies, who create forecasts. They're legally liable because they're creating these forecasts in the market out there, and they just whiff after time and time again. They whiff. I mean, Facebook, one of them too. Many companies do. If these big companies with their massive finance teams are unable to have predictable plans, how and why should we expect startups to be able to do the same?
Yeah, it's a good question. So I think first things first, right? Like there's a concept of what we call deterministic and indeterministic. When you're building a forecast or a model, you want people go into like, is the model accurate? The model can't be accurate because it's sort of forecasting what the future state looks like. And that's dynamic and has like, there's stochastic behavior to begin with, right? So accuracy is the wrong term to use. There's deterministic and indeterministic. And so when I think about capital market, particularly when I look at like large public companies, and analysts would come and say, well, they missed estimates. Okay, were the estimates wrong or was the actual wrong, right? And so I think that markets, public companies in general tend to be what I call euphoric and very optimistic. And that's why I think you're starting to see a change in behavior where a lot of them aren't comfortable giving corporate guidance. Not every company gives corporate guidance every quarter because it's kind of like the weather, right? Like stock price is kind of like the weather. You can have one bad quarter, but it doesn't mean the company is bad.
Or maybe said differently, you can have great predictions and plans, but if the Federal Reserve decides to change interest rate, the whole world has suddenly changed, and you had zero influence on that.
Yeah, and you have to re-underwrite the asset class in its entirety, right? Because to me, like discounted cash flow comes to mind. Like when interest rates go up, Buffett actually once said, interest rates are to asset prices as gravity is to matter.
Yeah, I saw that in one of your posts.
And so I think a lot about that. So, there's just all these kind of macro and micro events that can change what a stock price of a business looks like. So, yeah.
So how often, going back to you, I know you said it really is tied to your sort of overall business plan in a sense, building out this model. How many of the companies that you work with at Finance Within, do they all have essentially a business plan for the next 12, 18, 24, whatever months, like something that you're building off of, or do you require that of them? If you want us to build a financial model for you, we need to see the piece laying out the actual plan.
Yeah, I mean, most of our clients are kind of in the bookends of like what I call 5 to 50 million in revenue. So there's historicals that we can underwrite. So I don't really ask for a business plan or anything. I try to look at historical financials to help understand kind of the state of the union and kind of where the business has been. To me, that's an objective way of looking at the business. I try to get some inputs from the founder to really align on expectations and on where they want to take the business. And most founders definitely have like an accounting sort of books that we can reflect on. They may not have a budget or a pro forma or a forecast or even an operating plan. And so, typically for startups that are doing kind of in the 2 to 5 range, because we do have some clients there, we'd step in and we'd build that out for them and then transpose it into an operating plan and then work with the founders to like update the pro forma once the books close, whether we're doing accounting or not, like and kind of fractional CFO, strategic planning. We do that for practically all of our clients. And then for a number of them that need help on accounting, we'll step in and do their accounting as well.
Got it. So going back, I want to jump back for a second to the discussion you had around like acquisition and what made you decide to sell Social Within to Lamarck. What was the thinking that went on as in your mind as a founder? Why was that interesting? What are the metrics that you looked at to decide? Was it just a personal decision, you're tired, or was it a financial decision about what is the dollar value that I'd get today as a founder, and what could this do for me? Like, what was the mindset that you went through? Like, because founders are, of course, many of them, especially in today's environment, thinking through those questions, right? Should I sell? What does this look like? Should I shoot for the stars and maybe I get lucky enough to land in the moon, or do I explain? Does my spaceship explode on the ground before it even takes off? Like, what was your thinking there?
When I was building my last company, I don't think I thought enough about like M&A or like selling my business. It was very it kind of happened, I would say. It was in 2019 where we started getting interest from strategics.
Had you hit a certain revenue number? Like, why do you think you started even getting that interest? Was it?
I imagine that part of it is like in the conquesting process of them pitching business and us pitching business and we were winning the business. I think those things kind of play a role. It's a competitive dynamic naturally. because a lot of those larger shops they're pitching across the board, right? They're pitching large enterprise clients. They're also pitching startups and SMBs because they've got a sales force, et cetera. So I imagine that was kind of the initial trigger. Some really notable and published case studies coming out of some of those digital platforms. So there was certainly like goodwill and brand equity that was built around it. And some of the brands that we worked with were like some of the most notable companies in the consumer space today. And so I imagine it's kind of a function of that, because not everyone needs to know what your revenue is, well, how much like it's not normal to be in the market when you're not venture backed and you're not publishing your data to know what your revenue is. So I don't think it was that. I think it was just brand equity and goodwill.
But that probably has a metric, I would imagine, for almost every company, where you probably start to hit brand equity once you reach some sort of saturation, not saturation, but like you start hitting your stride in your market. You're doing a really good job. So people are noticing you. I mean, I actually tell founders the same thing sometimes, like, look, if you're really good, VCs will come to you. You won't even have to pitch them. They will come to your door because they will hear about you in the ecosystem. And it's, I guess, they're saying the same thing essentially when it comes to acquisition.
That's right. Yeah. Yeah. I would imagine that it was a function of all of that. One thing that we started to track was what we call ads under management. So like how much dollars are we managing in our portfolio across both doing the work and advisory work that we were doing, because we did have some clients that managed the media in-house but needed our advisory, for example. So that was that. And then the initial question, Adam, was
how did you decide to sell? Like why sell, right? If you're getting this brand equity, you're growing it, your big case studies, sounds like you're crushing it. Why leave?
Yeah, I think a few things that I thought a lot about was, first thing was, I can walk to my goals, I can run to my goals, or I can jump in a car and get there faster. And so for me, when you bolt on to a larger company in that's private equity backed, that had really the appetite to grow even further, why not jump in the car, right? That made sense. I think that was the main thing. The other was, I felt like my team could have a career path if they wanted to explore other roles in the business. Like I would have to create that. So being part of a larger company, you already have that in place. I think that becomes important. Yeah. I mean, candidly, yeah.
No, so like these are good answers, but I want to push you on it to some extent. Like I still feel like, okay, well, was there a personal financial motive for you? Was there there must have been something else beyond just, hey, like we can achieve our dreams faster and better because we're part of this bigger company.
Yeah. I mean, and I know I'm being sincere. Like I could have right-sized the business and grew it profitably and enjoyed kind of the fruits of the labor, but I'm not quite sure if I thought through. I don't know if it was as mechanical as a lot of people make it seem to be. Here's my general philosophy: the best time to sell your business is when someone is interested in buying it. Okay, that's a moment where you sort of levitate, feel buoyant, reflect in the spirit of the high performance S curve. And this feels like this is 2019, which feels like 20 years ago, but
what's happened in those 4 years.
4 years, right? And so it's, if I can, and I'm being sincere, like it's possible that I was at an inflection point of a high performance S curve. This time, not an individual contributor, but a CEO of a growing business, where I said, what are the optionality that can come out of this, right? I think you want to be in the game of options, whether it be career or capital markets or otherwise. Like, I think that all kind of contributed to the process.
Interesting. And then, so you decided to sell. What lessons? And this is still, I think this actually probably really a lot of the people who listen to this are in the venture capital tech space, but at the same time, so many companies in America, and this is meant to be for every entrepreneur, are service-based businesses. What are metrics that you think that service-based businesses should be looking at when, just as a business overall, if they ever are looking to sell? What are those metrics that they should be focused on when they think about what makes for a great service-based business?
Yeah, good question. Financial metrics, or are you talking about operational metrics or hygiene in general? Okay. Yeah. So I'll start from the top. Things that what I would call should pass the sniff test. It starts with financials. So things that I care about are net revenue growth over a period of time. I care about contribution margin or gross margin. Typically, and this may not be like gap audited best practices, but I like to basically look at cost of services or direct human capital associated with servicing clients to basically revenue minus that to get your gross margin.
What's a good gross margin percentage you think companies should shoot for? Or is it really dependent on the industry or growth rate?
It's highly dependent on the type of company you are. So like a software development company is going to be different than a fractional CFO business, is going to be different than like a marketing agency, is different than even like an events business or like a creative agency that's doing like bespoke digital creative work. So it will vary, but I think the way I think about it is kind of reverse engineer from the end in mind. So if you have if you have a goal to do 20% in operating income, then just work backwards from there in terms of what your overhead looks like and your other operating expenses look like net of labor costs or human capital expense, right? If you want to do 30%, if you want to do 40%, then you want to think through all of that. I think the natural appetite that a lot of founders have is I want to maximize profitability. And so I've always kind of cautioned against the idea of a 40%, 50% like net income target, not because that's not a good thing. I think there are trade-offs. So when a business is too profitable, their employee turnover is going to be high because they're burning their people out. And so you want to be really cognizant and thoughtful about what that structure looks like, especially in a people business, right? And they don't think about that. The other thing is when a business is too profitable, it's very likely that their sales function is working well, but their clients are likely also churning.
Isn't that at some point, is there, maybe it's just a delay, but isn't there some point where that actually ends up hitting your profitability? So, okay, fine, you can maybe crush it for a year, but if you're having high churn and you have high team turnover, at some point that is going to impact your ability to keep those margins high because it's really expensive to hire people. It's really expensive to replace customers. I'd rather keep a customer than have to replace that customer with a new one.
100%. And that's why I said it's a trade-off. So when I see a company that has a trailing 12-month EBITDA margin of 45%, that is likely not sustainable. In fact, it's very, very unlikely that they can sustain that. And if they can sustain it, they can't grow it. Does that make sense? So 45% EBITDA margin at $1 million business, okay, no problem. But like, what about 10 million? What about 20 million? You just can't sustain it. So that's I wouldn't call it a red flag, but that's like a sort of like a light bulb moment where it's like, okay, I'm curious. What is the likelihood that they can sustain it? Now, look, with the emergence of like AI and other services, I'm really keen to explore what I call tech-enabled professional services. Can they maintain their margin? Maybe it's not 45, but it's not 10 either. Can they find their steady state in the 25 to 35 world, leveraging technology and empowering and with human capital? So I think that becomes interesting. To answer your question, though, I would say from a financial metric standpoint, I think about, typically last 3 years of like revenue trend, EBITDA trend. I'm thinking about the client retention and churn. I'm thinking about their contracts. Like, is it a month to month? Is it a 12-month contract? What's kind of the agreement level they have in place? So I'm thinking through all of those things. And if I'm ever like involved in a deal, I'm contemplating on considerations that I would need to have in place when I'm looking to buy a business. And, oftentimes people say, oh, it's 2 million in EBITDA, so I deserve a 10% or a 10x multiple. And that should be in a cash capacity. Well, I'm open to exploring a 10x, but maybe it's 50% cash, 25% rollover in equity, and 25% earn out. Like those, you have to think through all of those considerations.
How does growth play into the margin discussion? Like, in other words, a lot of kind of maybe this past year, growth was all anyone cared about. Growth. Now people are much more focused in 2023 on profitability and therefore margins. What is the right balance between those now that we've sort of gone through, low cost capital days to being more like, how do you think through, what advice do you give your companies about how fast to grow given margin in once again, going back to your definition of success of, hey, like being a smart steward of the financials of a company and getting a fantastic financial outcome? What is the right trade-off between growth and even fueling that growth with some level of debt and margin?
Yeah. So I would say, I think step one is like when I talk to the investor bleachers, what I see is like when I ask, what do you care about, growth or profitability? The answer is yes.
Shocker.
Both, Faheem. And I say, I understand, but that's, so Look, I think the reality is that growth, the physics of any company, unless there's network effects built into it, like in a Google or Facebook capacity, the physics of most businesses is that growth has a trade-off with profitability because you have to reinvest in the growth, right?
Mhm.
So when you grow too quickly, you're likely negating profitability. So I just want to make sure that founders understand that there are moments where you can grow profitably, but to create a sustainable framework for to grow every month, every quarter, every year, and create like net operating income margin every single month, quarter, year, that's really, really difficult. So I want to make sure that we understand that as we go through
Is,
our journey as
is
founders.
is there one that you think founders, the most successful founders and best entrepreneurs, have focused on overall? Like, should you focus on growth more and just say, we're gonna burn the bridges, run as fast as we can? And I mean, there's some markets where it's like you need to own the whole market, so I get that. But maybe let's exclude the like we need to own the market and go as fast as we can to there. For the 98% of other businesses, is there a preference between growth and margin in your mind? Like, what leads to the best outcomes?
I'll give you an example. Like I'll give you a visual. When you run a marathon at the pace of a sprint, what happens?
Fall over, you won't finish.
You won't finish. You'll get hurt. You'll get injured, or something will happen, right? So you have to run a marathon at the pace of a marathon and a sprint at the pace of a sprint. And so if you're going to raise institutional capital, agnostic to category, right? And your desired outcome is we're going to go from here to here to here in the next 5 years, and then we're going to poke our heads up and explore sale. And these are the metrics that we care about, and we're optimizing towards that. Cool. We are running a sprint. So let's just call it that. In a software environment, I think that's really that can work because you front load a lot of the product development cycle, and then you're just iteratively making the product better, activating sales and marketing, and really kind of hitting the throttle on top line, right? And you care about things like MRR, ARR, and net revenue generated from contracts sold, and you care about things like ACV, average contract value. Those are things that you care about. And so I think you can run a sprint because you're actually running 110 dash, right? But for most businesses, that's not, you're running a marathon. And so this desired outcome of grow, 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 what you're going to end up, when a company grows, companies fail for two reasons. Non-software, not like I'm talking about most businesses, when they try to grow too quickly or they run out of money. Okay. So you want to make sure that you're being a good steward of capital, a good fiduciary to your own business. You want to be practical and pragmatic about what your growth targets are. You want to really understand. There's a metric that's on your balance sheet. It's called like sales to asset ratio. It's a metric that gets overlooked very often that not many people think about. And so I encourage anyone listening, like when you're looking at your it's part of like your asset management ratio. Lenders look at it when they're underwriting the business. Any credit provider, any good quality credit provider would look at it. Sales to asset ratio is basically thinking about, for every dollar in assets, what kind of sales can you generate? And so we've heard this term in software called asset light business. And what you find is $1 million in assets on the balance sheet can typically generate 10 million in sales, 20 million in sales. So your sales to asset ratio is very favorable. And then you look at a business like Caterpillar or John Deere or like these companies that are very asset heavy. And I don't know what their sales to asset ratio looks like, but you need to have a lot of assets on your balance sheet to be able to drive revenue, right? Makes sense. Delta Airlines, from jet fuel to the planes that they own, it's a lot of assets to facilitate the sales. What we find is most companies, startups and mid-market kind of SMBs tend to be asset medium, anywhere from 2 to 5, 2 to 7, whatever. So you want to understand that because when I talk to a founder that says, we did 2 million last year, we're going to do 20 million next year. Okay, I'm excited. I'm supportive of that. How do we get there? And they'll go into like all these other things. And what we don't understand is unless you're going to keep crushing your core operating metrics in the business, your asset profile, the balance sheet has to balance. So in order for you to go from 2 million to 20 million, your asset profile has to keep increasing because that's how sales to asset would work. How do you do that? Well, you generate cash from operations because your accounts receivable goes up and your cash goes up, right? And you're buying inventory, so your inventory account goes up. So that makes sense. But at some point, balance sheet has to balance. The liabilities and owner's equity has to match the assets. And so how do you do that? Well, you're going to have to raise either debt or equity. You can't bootstrap to the moon, as we say, right? So you have to be practical. And that's when you start to explore, debt products and we can talk about that.
Let's talk about that briefly, because that is one of the key questions I want to get to, because it's something that I think in the world we're in, it's something that's just a fascinating discussion to have about, do you take on debt instead of venture capital? How do you think through that? What should you be thinking in? And we're getting close on time, so we got to keep it kind of quick, but how would you think through debt and what that actually looks like?
So I actually don't think debt and venture capital are like mutually exclusive to each other. I think what's important is like you have to understand your relationship with capital. Not all dollars are created equally. Venture is different than private equity, is different than other forms of equity capital. So I think that's one. I think in debt, you have different types of products. You have short-term lenders, you've got long-term lenders. Within debt, you've got revenue-based financiers, asset-backed lenders, you've got commercial-grade bankers that are providing different forms of securities-based line of credit and other things, right? So I think you have to find the right debt product that works for your business. You have to find a credit partner that provides good customer experience. And I can't stress that enough. A lot of people don't think about that because they think that when you raise debt, it's all about the capital and the cost of capital. I couldn't disagree more. I think that's important, but I think that's table stakes, because in the growth plan and the growth and sort of the operating nature of a business, your planned performance may not be met, or you may miss target by a delta of $250,000, and that starts to impact your EBITDA. And so all of a sudden, if underwriting is happening every month, then you're going to be in a pinch, and they may hold the line back and you can't access that working capital. That's like little stuff like that, but it's kind of devils in the details. But really think about the right debt product and not treat equity and debt in the same lens. My kind of 10 seconds on this would be understand dilutive capital and non-dilutive capital, the difference between the two. And more importantly, using dilutive capital for working capital is the most expensive use of dollars. Try to use dilutive capital in operating the business and growing the business and investing in the growth. Use non-dilutive capital to invest in working capital and to grow the business from that standpoint.
So using you guys as a quick example, does a company like Finance Within, do you guys have debt? Do you take on any debt, or you don't feel the need for it? You don't want to grow faster? Like, what are the decisions you would make for your own sort of services business?
Most services business actually don't need to raise debt because you don't have to have a very large balance sheet. It's really a P&L business because there's not a lot of working capital associated, right? Generally speaking. But there are times where you have to explore it, typically when you're thinking about doing an M&A. So if you're going to do what I call a transformational deal, you're going to have to lever up the balance sheet. You're going to have to lever up the business to go and acquire another business, because you may not have the capital ready to go and pay out the founder of another company, right? So you have to think through that. But that'd be one of the main reasons why you do it. Otherwise, probably don't do it.
Avoid it. Don't take on the hassle. So Faheem, we are at time almost exactly. Going to give you over in a second. This went fast as I kind of expected it would. I still have a ton of other questions I want to ask you. I'm going to eagerly await your retro of how you did on predicting how the financial markets did this past year. I think, by the way, I think you were like 60% right, which is still pretty good. I don't know if I would have invested off of the insights you had, but I think it still is pretty good of your overall guesses of where the market would go. But either way, thank you so much for being here. And before we leave, how can people find you? If people want to get in touch, learn more about either work that Finance Within does, or just generally about either taking investment from you, or just about finance overall for earlier stage businesses, how can people get in touch?
Yeah, thank you. I've really enjoyed this. I would say if you want to get in touch with me directly, you can DM me on LinkedIn, just at Faheem Siddiqi, or Twitter. And then if you're interested in Finance Within, just financewithin.com. And I try to write a weekly or bi-weekly letter on kind of my observations around financial markets and private businesses and what I'm seeing. And that's just on my Substack, faheem.substack.com. So yeah.
I'm a subscriber, although I noticed you took a break for a good period of time, but it seems like it's restarted now, which is wonderful and lucky for all of us.
Well, thank you. I appreciate it, Adam. And thanks for hosting me. This was fun.
Absolutely. Thank you so much. Really appreciate it.